Welcome to the CBDC video series, a way for regulators, researchers, and international organizations to learn more about stablecoin technology, design, and policy considerations.
Okay, well, listen, thank you for inviting me. First of all, I want to thank everybody for joining us today. I know a lot of people got up on their weekend, so thanks for coming to have this really interesting discussion. I hope everybody is staying safe and healthy. Second, I would like to thank Dystopia Labs for having us on to talk about this. So I think as it was mentioned before, so my name is Ezekiel. I currently work as a partner for C Labs, which is working on the Cello platform. Prior to that, I was for many years a central banker working at the central bank, so the Federal Reserve Bank of New York. And recently, so about a year ago, I decided to leave New York and move to the West Coast to be closer to family. And since I've been out here, I've just been really amazed by the power and the spirit of the technology industry and how it's really working to solve problems. And so, one of those things I want to talk about today is this idea of digital currencies, and especially how important they can be during times of crisis and many of the advantages. So I'm going to go ahead and share. The presentation. I'm gonna reduce myself so that you guys can focus on the actual presentation. Perfect. Okay, so when having this discussion about digital currencies during times of crisis, especially during the COVID crisis that we're all living through, the most obvious advantage for digital currencies revolves around the delivery of money. So we've obviously all been, spending a lot of time thinking about, these stimulus money, these stimulus checks that, especially the U.S. government, but this is, all over the world, governments are trying to get stimulus money into the hands of their citizens. Right now, they basically have two choices. They can either do a direct deposit into your bank account, but that assumes that you, A, have a bank account, and B, that they know what your bank account is, or that they can send a paper check by mail, or some countries also will send a prepaid card that already has money on it. So if they don't know your bank details, or if you don't have a bank at all, the problem. So there's obviously a couple of problems, but the biggest problem is the speed. So for direct deposit, it can take days and weeks for the government to get that money to you, and for paper checks or for anything by mail, it can be even longer. There's some estimates that some people during this current crisis, they won't get their stimulus money until September. So one of the first advantages, of course, with digital currencies, with something like a digital dollar, is the fact that it can be instantaneously sent to anybody, especially if they have a smartphone. The second part of this delivery system is, of course, the cost. For direct deposit, costs I've seen estimates range from anywhere between 20 cents to $1.50 per transfer. So if you think about just in the US case, I think there was an estimate that they would be sending direct deposits to about 239 million people, which means that you're looking at about, you could see upwards of $360 million in cost just to send that money. And when it comes to paper checks or sending prepaid cards, those estimates are even higher. I think it's something about $3 a check. Which again is and then that doesn't even cover the cost of you having to get the check and then going to the bank and taking all that time, and especially now when people don't want to obviously leave their homes. So the next, so clearly when it comes to a cost perspective, the advantages of digital currencies is significant, right? So the U.S. government is going to spend perhaps upwards of $500 million just to get money to people. But if you had digital currencies, they could send that money for far, far less. Probably on the order of less than a penny per transaction. So you're looking at very significant cost savings. So the second advantage is probably not as sort of well known or well discussed, but one of the things when governments are sending stimulus funds directly to citizens, one of the things they want to make sure is that those stimulus funds are being used in the local economy. Right, the idea of the stimulus money is to stimulate the local economy. And so they want to make sure that when they send you money, that you are using that money to go to nail salons and grocery stores and restaurants. And so this is obviously in this current crisis, they don't want you to actually go to those restaurants, but they certainly want you to buy goods and services from those restaurants. COVID is clearly a specific case, but nonetheless, they still want you to be spending money at these restaurants, at these local merchants, to make sure that you keep them afloat. But of course, when they send, when they deposit money directly into your bank account, or when they send you a check for stimulus money, that's as far as it goes for them, right? They can't really control where you spend that money. And so, it's just sort of left up to you whether or not you spend it in the locations that the government, wants you to spend it at. But the interesting part of the digital currency, especially with smart contracts, is that if governments give you stimulus funds, they can help direct where that money goes to, and they can, through these smart contracts, can make it possible for you to only spend it at local retailers, to make sure that you're helping to provide, economic support for your local community. So now the third advantage to digital currencies is actually one that's going to take a little bit of understanding of economic theory. So hopefully you guys can bear with me a little bit. But I think it's probably the most profound aspect, and certainly the least discussed right now, because it's not maybe well understood. But the third advantage of digital currencies is really around this notion of making the stimulus money effective. So first you have to get it to them cheaply and efficiently. You want to direct it to specific entities. But then the third thing is that you want to actually make sure that people are spending the money. So when you look at this chart, basically, what I want you to take away from it is this is essentially kind of the activity that happened around the great financial crisis in 2008. So in 2008 and in the 10 years since that crisis, the U.S. money supply was increased by $2.2 trillion. And essentially what that meant was, the U.S. government gave out stimulus checks to people. The Federal Reserve created quantitative easing programs to increase the amount of money. And the economic theory behind that was that if they put all of this money supply into the economy, then the economy should grow by that green line. Meaning that the economy should, it started at around $15 trillion. Assuming that economic theory held, then, the economy should actually see a massive growth because of all this new money, because then people would go and spend it, and it would grow the economy. But unfortunately, that didn't happen. So the gray line is actually what really happened. And we're going to get into why, and then we're going to get into how digital currencies can help with this. But right now, suffice to say, what ultimately ended up happening was the U.S. economy grew by about 5.3 trillion, when if economic theory were to hold up, it would have grown by more than 20 trillion, given the massive amount of money supply that was injected into the economy. So the reason for this revolves around this idea of the velocity of money. So the velocity of money, simply put, is the number of times that a dollar or any currency is used to buy something, right? So the more times a dollar is spent in an economy, then the greater that economic impact is. So if we look at sort of the first example, and again, these are extremely simple economies that are just sort of used to prove a point, and to kind of sort of simplify things. But assume you have an economy where there's a carpenter and a baker and a farmer, and that's it. And also the only money in this economy is a $10 bill, and currently the carpenter has it. And so the carpenter decides to go to the baker and buy some bread, and so they use that $10 for the bread. And the baker then will use the $10 that he just got from the carpenter and will go to the farmer to buy more wheat and give the $10 to the farmer. And then the farmer will go to the carpenter and say, I need you to build me a silo because I'm selling lots of wheat. And so I need to kind of have a new storage place. So the carpenter will build this new silo. Now, if the carpenter then somehow, if there's an economic crisis and the carpenter decides, well, I don't want to spend any more money, I don't want to buy any more bread because I'm worried about when my next job will come, then that system kind of stops, right? So then the money doesn't flow anymore. And so you can see here that $10 was able to basically create an economy of $30 because it was used 3 times. But in example 2, if that carpenter kept going and the money just kept flowing around, then you can see that how the velocity of money will actually help grow an economy. So, but the problem with money velocity as it stands now is that it's impossible to track the circulation of banknotes, right? So we have no idea. We know how many banknotes exist, but we don't know, if I give you $10 or if you give $10 to your sister or whatever. There's certainly no way of understanding how the banknotes are being spent throughout a system. And so the way that we understand velocity at the moment is purely abstract. So economists basically take the nominal GDP of a system and they say, okay, well, let's divide that by all of the money that's in the system. And that will give us the velocity, right? So there could be a velocity of 5, which means that, for every dollar circulates throughout the economy about 5 times. But since economists don't understand, the real-time insights for velocity, what they do is they tend to not focus on velocity and they focus on money supply. So if we rearrange that first equation, we get a new equation that says that velocity times money supply will equal the nominal GDP, right? So that will equal basically a country's economy. And so the idea is that, well, if you don't really understand velocity, let's just hold it constant, right? So whatever velocity is right now, let's just say it just stays constant. And if we increase money supply, then, by this equation, that means that we should see an equivalent rise in GDP. So now going back to that chart we have, the problem is that, economists, when they increased the money supply by that massive amount, by 2.2 trillion, they were sort of, effectively saying to themselves, okay, well, let's assume that the velocity of money is held constant. And this is represented in this chart by that dotted green line, right? So I just took basically the 10-year average of velocity prior to 2008 and said, okay, velocity is going to be somewhere, around 9 times. And so they thought, okay, well, if that holds, then we're going to, flood the system with money. Everyone's going to take that money and spend it, and that's going to support our economy. But in reality, what happened is velocity didn't stay constant. Velocity actually declined significantly. So, and that's represented by that gray dotted line, which so you can see velocity went from more than 10 to about 5.5 times. And that result, right, that result of declining velocity then muted the impact that all of this money that the government was putting into the system. So again, that's why you get that gray line instead of that green line. So the reason that velocity, so the reason that, when the government flooded the system with money and the reason why velocity declined has to do with the conflicting roles of money. So for many of you, you probably understand, so money basically has 3 roles that we think about. So one is the unit of account, which is basically just essentially says that we denominate everything, for example, in the US, we denominate everything in dollars. And it makes it easier for us to compare our, to compare goods and services and things like that. Another role of money is as a store of value, which basically says, that, I have a certain amount of money in my pocket that will buy me a certain basket of goods. And, assuming that money, retains its value, then that basket of goods that I can buy today should be roughly the same as the basket of goods I can buy tomorrow or next month or something like that, which is just to say that, that money will retain its value. And the third role of money is this notion of using it as a medium of exchange, right? So we don't have a barter system anymore. So instead, we buy goods and services by exchanging money. And so it makes it much easier for us and much more efficient. So the problem, however, is that, during times of crisis, people tend to favor money's store of value role instead of its medium of exchange role. And this is completely understandable, right? I mean, obviously when there's a crisis and you don't know, if you're going to be able to keep your job, you don't know how much money you have, and if you're going to, where your money's going to come from in the future, you obviously want to hold on to it. But at the same time, then what that, and that's fine if only one person does that, right? But if an entire economy decides not to spend their money, It's kind of like in that smaller economy, right? Where, if the carpenter is not spending any money, then that means that there's no more money for the baker, and then the entire economy kind of grinds to a halt. But there was actually, so there's this notion of hoarding, which is sort of the term that we think about. But there's actually a solution to this that came about 100 years ago from a German economist who, in order to solve this problem of hoarding and to increase the velocity of money, he came up with this idea of stamped money. So we're gonna talk a little bit about this. So the idea of stamped money was that, in order to get people to continue using money as a medium of exchange, this economist decided, well, what if it actually decayed in value, much like the goods that it was used to procure? So, for example, like if you have a whole bunch of potatoes, you won't be able to keep them forever, because eventually you're either gonna have to eat them or you're gonna have to trade them away for something else, because the potatoes will eventually rot. And the idea was, well, what if we kind of, make money that way as well? And that would then incentivize people to use the money, and then that would actually, help support the system. So this idea of stamp money came about, and they actually used it in an experiment in a small town in Austria. And the idea was that the government gave people these banknotes. In this example here, you can see they're worth about 10 shilling. And the idea was that in order for these banknotes to be viable and to be used, you had to make sure that there was a stamp fixed for every month that you were in, right? So, right now that you can see there was a stamp affixed in January. So this banknote would be good for the month of January. But of course, then once you get into February, for you to actually use this banknote, you would have to go and buy another stamp and affix it to this banknote, and then you could use it again. And so the idea was that, well, people would probably prefer to spend their money than to have to go and buy another stamp to make it viable. And this, and what actually ended up happening was it worked. This experiment lasted for over a year, and it helped increase employment growth. It helped increase the economy because people were spending this money that they got at their local stores, and they were helping to support their local markets and their local retailers. And in fact, so at the time, this was in the 1930s during the Great Depression. And so at the time, there was a very prominent economist named Irving Fisher who said this was an ingenious scheme and thought that it was probably the most efficient method for basically controlling hoarding and getting us out of a depression, which was certainly very topical in the minds of people back then. And the fascinating thing is that with technology, we can do that, right? I mean, obviously, requiring everybody to have a stamp on their dollar bills is not going to be efficient or really pragmatic, right? But with technology, we can do that now. We can help influence this velocity of money in a couple of ways. One of which is we can do a demurrage fee, which is essentially like requiring people to pay a fee, right? In this case, they were paying a stamp fee, but you can put a demurrage fee onto money, and then they will, hopefully then be incentivized to spend it. Another way of doing it is to do it through a cashback scheme. So I appreciate you bearing with me on the theoretical side of this. And it was important to sort of talk about the theory behind it, because I want to show how with technology, we can do something that we've never been able to do before, which is we can take this theory of velocity and we can actually make it practical. So in the first instance that I was talking about was this notion of influencing velocity through demurrage. And so the idea here is that, if the government decides to implement a demurrage fee, then what they would do is they would say, okay, well, if you don't spend the money over a certain period X, whether that is a month, a week, a day even, then we will charge you a fee. So clearly here, in 2A, if the person spends the money before T plus X, then there is no fee assessed. But if they do, wait and they spend it after that period, then of course a fee is assessed, and then that fee would go back to the government. Of course, the person can obviously still spend the money; it's theirs. but it's just this demurrage fee then goes to kind of incentivize them to spend that money. And the interesting thing here is that the government can take the accumulated fees and they can use those to help pay for social welfare programs, such as unemployment. Of course, if that's too punitive, another idea is this notion of cash back. Especially many of us here in the U.S. are familiar with this idea of, cashback credit cards. They get you to, they want you to use their credit card, and so they have these cashback schemes. And the interesting thing is that while it's not a new scenario, it's not a new idea. It is, this new technology allows people who don't have access to credit cards. It allows them to have this kind of type of financial service and this financial incentive, because there's a lot of people, there's, hundreds of millions of people that don't have access to credit cards, that don't have access to bank accounts. And so this idea of a cashback scheme really wouldn't work for them. But in the cashback scheme, of course, the government would give you stimulus money, and the idea being that if you spend that money at specific merchants like local restaurants or travel stores or whatever, that you would then get cash back on that purchase. And you could do that, through a smart contract. And this doesn't have to also be funded by the government. Restaurants or, other local merchants can also fund the cashback scheme through sort of like a loyalty program as well. And the interesting thing is, this can actually help sort of prevent government bailouts, right? So instead, the government can help direct recipients to spend their money at industries that are particularly hard hit, like, for example, restaurants or travel. You can also use this during times when we're not in a crisis, right? So you think about the incentives that governments have right now for energy efficient appliances. You can still do that, and it's actually more efficient. Instead of having to wait to do this through tax policy, you can just simply do it through your currency. And then you can also have a hybrid model. Where it's just essentially saying, look, we're gonna, give you the stimulus money. It will have a demurrage fee if you don't spend it over a certain amount of time. But regardless, if you do spend it at these local merchants, we're gonna give you a cash back as well. So there's lots of different ways in which you can think about how to incentivize people using digital currencies to actually increase the velocity of money. And then that will actually then help to support and increase the economy. And so the last thing that I want to talk about, so regardless of whether or not a government decides to implement some of these like demurrage fees or these cashback schemes, another really valuable part of digital currencies is just this ability to actually understand the velocity of money, right? So now that we have access to real-time transaction data, we can understand what's happening in the system, and we can have a real-time sense of how monetary policy is being implemented throughout the system. We can understand sort of the risk and where various risks are happening. We can embed supervision to make it a lot easier. And so that is my presentation. I'm gonna go back now, and I will take any questions. Let me just get into system here, and I'll see. I'm going to stop sharing my screen, and I'll see if there are any questions. So let me look down here at the question section. Okay, so someone asked about the chat. So I guess so I think there were problems with the chat, so apologies for that. All right, so it says here, for restricting the way money is spent and misogyny sounds like Orwellian, very scary. Where do you see the right balance between government control? Absolutely. This is, the idea for influencing the velocity of money is something that would be used by governments during times of crisis. I certainly understand this notion of how do you square sort of decentralization between this more control over money. I think the idea here is that, during times of crisis, you need to have as many levers as possible to get the economy going. And the thing is that all of this would still be done with anonymity, right? The government doesn't know who you are or where you're spending your money. The idea is that the government is just trying to incentivize you to spend that money. And so I think that's probably the biggest thing. Let's see here. So should a digital dollar be somewhat auditable for the population? It's a total distribution. I think obviously, when you have when everything is on a blockchain and everything is available to be seen, then you are going to have a a certain degree of audibility, right? I mean, we have it now with statistics, but certainly those are backward looking. And so those are, sometimes harder for us to see in real time. And then what that does is just delays the policy response. And so I think the idea of having more visibility into the economy is certainly a very good one. Let me see here, the next one. So what do you think are the relative merits of different types of stable coins, crypto dollars, fiat backed? One of my colleagues is actually going to have a discussion. Marcus Frank is going to have a discussion on the different types of stable coins and how those are, how their different stability protocols work. And so I think his spot is coming up later today. Look, I will say that, no matter how the stable coin is backed, there are certainly pros and cons with everything. I think that, one of the interesting things is just this idea of being able to program money is something that as a former central banker, we never had that ability before. And I think that's the bigger sort of advantage and the bigger, more profound thing. Right now, the way monetary policy works is we try and influence the price of money. We do that through interest rates, right? So we try and make money more or less expensive. And we've seen that can have varying degrees of success. Obviously, when we get to an area where interest rates are so low and even negative in many places, that makes it difficult to continue to influence the price of money. And so the idea is that instead of focusing on the price of money, let's focus on the speed of money and the velocity. And so let's try and find a different way around monetary policy. Let me see here, make sure I haven't missed any. So something here says, how was the decline of velocity measured? In one of the first paragraphs shows actual decline. So right now, the way we measure the velocity is really abstract. We just simply take the nominal GDP of economy and we divide it by the money supply. And there are different money supplies. There are things called M0, which is just cash. There's M1, which is cash and commercial or CDs, certificates of deposit, etc. And so there are different ways, but essentially it's just we take the overall economy and we divide it by how much money there is. So unfortunately, it's not a very robust measure.
Ezekiel, I think we're at our last question. So if you can just pick one more, that'd be great.
Great. So there's one last one here I think I missed. So speaking of forced velocity, any thoughts on Japan's time-limited shopping coupons for the 90s? They tried airdropping. Astonishingly, many hold on to them to the point where, yeah, it's interesting. I mean, this would be somewhat of a similar idea. I'm not familiar with this airdropping of these coupons. It could be something that maybe they were only limited to one specific store and people just didn't want to sort of shop at that store. I mean, the idea is that, people want to spend money as opposed to spending coupons. But yeah, it's an interesting idea. I don't know. But anyway, so I'm apologies that I wasn't able to get to everybody's questions, but I want to thank everyone for coming out. You can read, we have a paper on our velocity work at cello.org/papers, I believe is the URL. So I certainly would direct you guys to that. And please feel free to reach out to me as well. So thank you.
Awesome. Thank you so much for the talk. We'll post this links to the slides and also the paper later today. All right, we're going to transition to the next talk now. Thank you guys so much.